think, as most people are aware, it's been a pretty volatile market this year and pretty dynamic, and more so than we've seen in the last few years. And it's been a challenging year for us with our strategies. And interestingly and sort of frustratingly, we came into the year thinking it would be a tough year. So if you remember from our fourth quarter letter last year, we said that we thought 2015 would be a challenging year for the markets, and that's pretty much played out. I think what's caught us by surprise is that dividend-paying stocks have performed worse than the market this year, which is frustrating, and I think a lot of it has to do with concerns over rising rates. The big dynamics this year have continued to be, as we've seen in the last couple of years, sort of the macro themes and concerns that people have been focused on. So one of the big ones obviously has been oil and the decline in oil prices, and it aligned with that, declines in commodity prices. The other big questions have been around things like interest rates here in the United States and abroad, a slowdown in China. So it's interesting that there are times when the market seems very focused on company-specific things, how companies' earnings are growing, what sales are like, and times like the last few months and this year where it's really been about more global macro considerations. And so it's been dynamic, volatile, and probably that's likely to continue. Performance for the dividend portfolios this year has been challenging, and it's been challenging largely kind of across the board from a dividend perspective. So when we look at, which we do routinely, our attribution analysis, sort of what's driving our performance, both just with respect to our strategies themselves and then relative to the market or other strategies out there, we find that the key drivers have been largely the fact that we're so focused on dividend stocks. And so what that means is that sometimes there would be a time in the marketplace where you would see, well, it's the fact that we're underweight a certain sector or overweight a certain sector is what's driven performance. That's not the case this year. What's interesting is that we've done analysis where you sort of cut the market by levels of dividend payers. In other words, sort of the highest dividend payers, sort of the top 20%, the next 20%, and so on down. And what we found is that there's a stark difference between high dividend payers and their performance this year and low dividend or no dividend payers. So the top 40% of dividend payers in the S&P 500, in other words, the 40% of the companies that pay the highest dividends, are down about 10% this year. Whereas if you look at companies that pay no dividend or sort of the next level up, sort of no or lowest dividends, they're flat on the year. And so it's a huge, huge difference. I mean, this is normally in our business, people would talk about things being outperforming by 50 basis points or 0.5%, and here we're talking about 1,000 basis point difference between dividend payers and non-dividend payers. And so really, when we look across our performance, the fact that we're focused on high-quality dividend payers, which normally we would think of as being a really strong attribute, has hurt us this year. And I think, and we think that the key reason for that is really twofold. First off, high-quality dividend payers have done really well the last several years, and so there's been a piece of sort of giving back some of the gains that they've had or the successes they've enjoyed. And then the second is that throughout the year, the markets have been very focused on the potential for rising rates. And so we've seen lots of yield-sensitive or things being perceived as yield-sensitive investments get hurt ahead of this rise in rates. One of the things that's been interesting about that is that the ultimate rise in interest rates keep getting pushed off. And so I think, we came into the year and people thought it would happen in the spring, and then it was going to happen in September, and now people are talking about, well, could it be October or December? And we're not overly obsessed about exactly when it happens or even if it does. We believe, and have believed this for some time, that we are going to be in a very low interest rate environment for sort of as far as the eye can see. So whether the Fed raises by 25 basis points in 3 months or not for 6 or 9 months doesn't really make a big difference. We believe we're in this low rate environment, and actually that our names and high quality dividend payers are very well positioned. So we think there's a bit within the market, sort of this de-emphasizing or pivoting away from high-quality dividend payers that we've seen this year. We think that's a little misguided, because we think with the interest rate outlook that we expect, which is low rates for a long time, that high-quality dividend payers are going to be a great place to be. We've been very consistent since the great financial crisis, sort of on our macro outlook, and that is that we've been saying since 2008, 2009 that we thought the global recovery was likely to be slower than in past cycles and less exciting than people have hoped for. And at many points in the last several years, there seemed to be some sort of disconnect between the markets and the sort of enthusiasm or ebullience in the markets and global GDP growth, which has been lackluster. We're at a point in time right now, sitting here, towards the end of 2015, where the world and the market seem to be focusing again on the fact that growth is likely to be less than exciting and lower than people would hope. We're not surprised by that. That's consistent with what we've continued to expect, unfortunately. And so we think going forward for the markets that and for our portfolios that as people start to digest the fact that global growth is going to continue to be slower than people would like, that they will come back to the kinds of names we own. In other words, that high-quality dividend payers with recurring revenues, big moats, great balance sheets are precisely the kind of companies one wants to own in a slow-growth global environment.